Adam Wyndham, Chief Operating Officer at Host Financial, gold sponsor for the upcoming Miami Live event, November 2nd and 3rd. I want to thank you in advance, not only for your time now, but also for flying down to Miami and educating all of our hosts and entrepreneurs there about some of the solutions that you and your team have not only developed, but are working on, and sort of where you see financing for short-term rentals going forward. As I've said time and time again, the single largest obstacle for all of us to grow and scale our short-term rental business is the fact that short-term rentals are misunderstood by very conservative bankers who view the vacancy risk of, I don't know how many days or weeks or months it's going to be vacant, and I also don't know what the nightly rate is. They view that as really risky, and they don't really peel back a layer and take a look at the cash flow and realize that while there is more risk, there's also far more reward. But that's what Adam and his team do. I've currently done one major construction loan where I was turned down 3 times by commercial banks who all said yes, and we did tons of due diligence, and not until the very end did they say no. But Adam and his team came through. That deal is closed, and I appreciate that very much. And I'm in the process right now of refinancing, cash out refinancing one of my short-term rentals, again, with Adam's help. So, Adam, thank you very much. And maybe you could give us a little introduction into yourself and your team and Host Financial. And thanks again for being a gold sponsor of the Miami Live event.
Oh, no, we appreciate it. And, really looking forward to the event. It's sounds like, it's going to be very exciting. I'm looking forward to connecting to, a lot of your followers and, just the audience that you.
Real quick.
But yeah, just the quick
Adam
overview of Host Financial is, what we specialize in is we provide creative financing solutions for real estate investors. And one of the niche markets that we operate in is obviously the short-term vacation rental space. So we've developed a network of capital partners that.
No, it's audio. No, sorry.
Yeah, we've developed a network of capital partners that we've kind of helped design programs that are specifically suited for the short-term vacation rental industry, solving a lot of the problems that you touched on kind of in the introduction. Issues where institutional financing or traditional banks view short-term rentals, they don't view them the same way as you would view another income-generating asset, which is kind of crazy given how mature the short-term vacation rental space is. I mean, I think Airbnb launched in 2008, so we're approaching on 10 years, but capital markets are notoriously slow to update and adopt new technologies. So what we've been successful in doing is really kind of highlighting the advantages and the cash flow numbers that you were touching on in the short-term space, and presenting that to our network of capital partners, and really highlighting the opportunity that exists to fund these type of deals. So that's kind of how Host was born, out of filling that need that we saw in the marketplace, where there wasn't just the access to capital for this type of project is significantly curtailed in compared to normal either real estate or investment products. So that's what Host was born out of, was to fill that need.
Walk them through a little bit about the different options that you guys have, how you project rent roll, what sort of LTVs you get, what sort of credit scores people need, just so they have a framework. If at a minimum this recording doesn't really work as well as possible, we'll reschedule it. But the people that have shown up and are interested could be great clients for you that are eager to learn and grow. Give them some of the things that would be really relevant for them in making a decision, and hopefully encourage them to contact you to start the process.
Yeah, so one of the big things that we're able to do that's different than what your traditional financial institution that you may have encountered going down this road, is that we underwrite and fund all of our loans primarily based on the income of the asset. So we don't necessarily look at a person's tax returns or W-2s or personal debt to income ratio. That's not really an underwriting factor for us. the main factor we look at is the cash flow of the property, what the property can generate, and then we compare that to what the cost of the financing is. And that's the primary way that we, underwrite and qualify these type of deals. Of course, through the process, we always need to see a credit score from the borrower. So, a FICO score is always going to be important to have. And obviously, the higher your FICO score is, the better the rates and terms are going to be. But the real differentiator there is that rather than looking at your personal income picture, seeing how much money you as an individual generate, and whether or not you qualify for the amount of financing you need to purchase the property, we look at the income of the property and its ability to support the cost of the financing, the debt service. So that's really the unique thing that we're able to do, not just for short-term rentals, but long-term rentals, all kind of investment assets. That's what we do at Host. We specialize in providing those type of creative solutions, and the short-term space is definitely, one of the areas that we're, very active in. And what we're able to do, while you're, looking to grow your business or, potentially refinance properties that you currently have, is that we can look at that short-term vacation rental income and treat it the same way that we would treat a normal 12-month, traditional long-term lease income. So we can go off of projections, we can go off actuals. A lot of our borrowers, they use the familiar third-party sites that I'm sure a lot of your listeners are familiar with, whether it's AirDNA or MashVisor or Renometer. We can take projections from those sites and utilize them as part of the underwriting process. And as far as LTVs and things like that are associated, so for purchases, we can get up to 80%, 75 to 80%. And what really kind of makes the difference for that 5%
which is huge, right? Like,
yeah,
that's what's been missing.
Yeah, I mean, most for investment business purpose type financing, that's very market. Even if you're qualifying for the financing with your personal income, for investment property, most lending institutions are going to look to see that amount of down payment. But yeah, we can get up to 75, 80% on a purchase. And really what makes up that 5% difference is, when we look at a deal and we're underwriting, we'll look at in a purchase scenario, we'll look at what the projected short-term vacation rental income would be. And then we also look at what, the traditional market rate income would be. And if we're underwriting with both of those different income streams and we're hitting certain DSCR metrics, then we're able to push the LTVs and get more aggressive on rates. Because if the property is cash flowing and cash positive as a short-term rental, as well as, a traditional long-term rental, from a risk standpoint, it's just a more stable asset. So we can get, a little bit more aggressive on the LTVs and more aggressive on the rates, versus if it's only cash flowing or only covering the debt service just with the short-term income, which is traditionally higher, a little bit more risk exposure there. So that's where the LTVs will kind of tap out at about the 75% mark. Similar situation on the refinances, we can do 70 to 75%. And what kind of makes up that 5% difference is whether we've got seasoned income history. So it's always better, or in a refinance scenario, if you have a minimum of 12 months of track record, it's the same kind of concept from a risk perspective. You've proven out those numbers. So, our capital partners get more comfortable with the higher LTV, a refinance that doesn't necessarily have those 12 months. But we can do both deals. It's just the LTVs and rates will kind of shift around based on the factors when we're underwriting.
Sorry again for the audio delays and so on, but that was really helpful. But what I'd like to do is actually take a step back and describe, in your words, please, DSCR. Some viewers may not know what that actually is. And then the second thing I want to share with everybody is just the fact that this can happen for a variety of reasons. So in my prior life, when I had really large income and was just starting to scale my business, I would run up against problems with traditional lenders that would say, we don't have a program for people that have more than 5 homes or 5 vacation homes or 5 second homes or whatever it was. And then in speaking to them and saying, well, this is a vacation home, but it also has rental income, they just really tuned out. So even if you have huge income, you may get tapped out through the traditional loaning route because they may have a limit, even though it makes no sense. It's their rules, it's their bank. So like that might be their limit. Or in the situation that I find myself in currently, where I have a lot of assets on my balance sheet and I have a lot of liquid net worth and I have a lot of strength on my balance sheet. But the last couple of years I've been through transitions. And so my W-2 income is just not that great. And so to not have to qualify against me because I already own all these assets and all that cash flow and all those liabilities, to have the income that the asset generates be underwritten, that's much more traditional in the way that it's done in, say, multifamily and in commercial lending. You're looking at the asset. And so that's really what Adam and his team and his lenders are doing, is looking at this asset class very similar to other asset classes. And then, to be fair, charging a small spread or a premium for the additional risk that they incur. But given the profitability that we're experiencing in the short-term rental market, like, don't get stuck on that, because this is deal or no deal, and this could be the future and the pathway to you really growing your business from 135 to 5, 10, 15, 20, right? So Adam, let us know what DSCR means, please, and then comment, if you would, on why other lenders aren't looking at it the way that you guys are.
Yeah, so DSCR just stands for debt service coverage ratio. All it means is comparing, the monthly income that the property is generating to the monthly principal, interest, taxes, insurance, and any HOA fees. So it's a metric to compare how much over the cost of the financing it is the income. So if you have a DSCR of 2.0, that means your property is grossing 2 times the amount of the monthly principal, interest, taxes, things like that. And to your point, so what you described is a very common challenge with a lot of real estate investors, whether they're just starting out or even high net individuals. They could be working with a local bank or credit union or something like that, and they may be able to get 1 or 2 deals done. But at a certain point, and I've experienced this with a lot of clients that we work with, is they basically say, yeah, we got 1 or 2 deals, maybe 3 deals done with a local bank or credit union, but then they kind of, those local institutions kind of reach their risk tolerance in terms of lending to that individual, and then kind of pump the brakes and say, let's hold off, let's see how these properties perform, and then we can still talk about extending you credit after that's kind of proven itself out, which obviously presents a problem for anyone that's looking to scale in any type of significant manner. So that's number one. And then I guess the second point that you brought up is that most people, when you're in this real estate investing game and you have multiple properties and multiple LLCs, you try to pay as little in taxes as possible, right? That's the whole idea, is to reduce your tax burden. So under the traditional route, when people start looking at your tax returns and K-1s and things like that, you're showing it the least amount of income as you possibly can. So that's to reduce your tax burden, obviously is smart, but then has the flip side of, kind of impacting your ability to get additional financing with those traditional routes. And what we're able to do, and with our network of capital partners, is really, we don't really have a limit, so to speak, in terms of the amount of financing or the number of deals that we would extend to any person over a given period of time. Now, there's obviously caveats to that. If you went out and wanted to buy $15 million worth of real estate in 6 months, I think that there would be some people would pause for a second, just confirm that you truly have not only the equity, but the reserves and the infrastructure to support something like that. But generally speaking, there is no real limit. So it's a great option for people that are looking to scale, looking to jump on properties when they come up and they're available and it's a good deal and you want to move on it quickly and you want to grow your portfolio. It's a great option for those type of investors and that type of investment strategy.
Yeah. So again, I'm delayed. So I'm listening to you, but now I have to take my headphones out, and I totally apologize. But there's a couple of things. When you say that there is a limit, there definitely is a limit, but it's a lot higher than many people think. So just in my particular case with my underwriting, even though the assets are being underwritten, Adam and his team were able to extend a $10 million line of credit, which is great. That gives me a ton of opportunity to start new construction and new projects. And for the Outer Banks project, I have nearly 30 acres of waterfront property that I'll be developing. We're starting with the first house. And so Adam and his team provided us the construction financing on that. that's going to be somewhere in the, call it $3 million range of construction, but I have a $10 million line of credit. So I could start the second home sooner rather than later. And so there's a lot of really interesting and innovative solutions that they have. And I encourage you to reach out to them. Again, the way that, my channel works and my affiliate programs and any relationships that we're going to introduce are going to be based on products that I personally believe in and I can support and so on. So I have firsthand experience here and it's been really great and I very much appreciate it. Adam, I'm going to read a couple of questions. People are asking about what's the minimum dollar amount that you will loan? Are there any states that you don't loan in? Will you lend to a new LLC that's just set up for this special purpose? So I'm going to start to go through some of these questions.
Sure. Yeah.
And I appreciate everybody dealing with, my technical challenges.
Yeah. So I think I remember. Okay, yeah. So you mentioned minimum loan amount. Yeah, typically minimum loan amount is around 45 to 50,000. It's difficult to get any type of institution to extend, a loan below that. It just doesn't make economic sense when you factor in the points and the fees and the underwriting and everything else that's associated with doing a deal. Those lower dollar value loans too typically get priced higher too for the same reason. Sweet spot for most, institutions, I would say, is like a loan value between, definitely above 100,000, but 2 to 4, 2 to 3, I think is probably a sweet spot. But we can do the whole range. But in terms of a minimum, it would be 45 to 50,000 on the loan side would probably be the smallest deal that we could do. In terms of states, we're still working on Arizona right now, as well as a couple of other states such as Nevada and Oregon. They just have different lending laws, and the licensors that are associated with us and our capital partner just is something we're still working through and hoping to have those resolved, by the end of the year. States that we don't currently have any plans on expanding into, at least not in the near term, would probably be like the Dakotas, North Dakota, South Dakota. Those are difficult places to lend in as well. But other than that, we pretty much cover the rest of the continental United States. Yeah. And then I think there was, the question about an LLC. Yes, all the time we lend to newly formed LLCs. It's a very common structure amongst real estate investors, not just
Adam. So there's a question
space, but any.
New LLC.
No problem.
But there's additional questions on geography. Canada, U.S. Virgin Islands.
No to Canada. Virgin Islands is actually, I'm going to say probably not. I need to go back and double check. It's actually a request we haven't received recently. So.
And Hawaii.
Mark that as a maybe. Hawaii is a yes. I'm actually working on closing a deal right now in Hawaii that'll fund on Thursday. So 2 days from now. So yeah, we can do Hawaii. But Virgin Islands is maybe. Yeah, I'm not sure. Would need to look in that. Same would go with Puerto Rico. So let me get back to you on that, and I can update you in Miami on that question.
Awesome. And then there's a couple of questions here regarding do you have any restrictions on older properties such as those with knob and tube wiring?
No, at least not that we've run into. Sometimes the age of the asset can present a problem. If it's something that's built in the 1900s or something like that. But generally speaking, provided the asset's in good condition, there isn't restriction or problem on lending on something like that. Up to code, and something that's just not in disrepair or something like that. For those type of properties, what we tend to do, for investors that are looking for those type of opportunities to generate equity, what I recommend is, going in with the renovation type financing, where you're allowed to pick up the property and, improve it and kind of do some forced equity generation, and then refinance into the permanent stabilized, STR, LTR, perm financing once renovations are completed.
So Adam, there's some love coming from the community here. Marion says you're doing a great job, especially with all this adversity. I mean,
Yeah.
who knew this would be so hard? And then there's another question here on your financing. How are your loans structured? 30 years fixed, 30 years fixed, 5/1 arms. What are some of the choices that you guys have? I mean, I could answer this, but I'd rather you do it.
Sure. Yeah. So all of the financing we provide, it's all 30-year amortization periods. So we don't have any balloon payments or anything like that that some of your listeners may be familiar with by going like the hard money route. And then in terms of term lengths, we can do all the standard term lengths. So 5/1 arms, just meaning, for those who aren't familiar with the terminology for arm structures, the 5 of a 5/1 arm just means that the interest rate is fixed for a period of 5 years, and then it will adjust annually each year thereafter. And it's typically based on a spread over the 12-month LIBOR. So we can do 5/1 arms, we can do 7/1 arms, we can do 10/1 arms, we can do 30-year fixed, and we can also do 15-year fixed over a 15-year amortization. Definitely not something that's, I would say, common or popular outside of a few subset of investors, primarily meaning, if you're shortening the amortization period from 30 to 15 years, you're paying the loan off, twice as fast. So your monthly payment is higher. So, from a cash flow perspective, depending on what your investment strategy is, that certainly eats into it. My 2 cents is typically what I see is more common, especially amongst, I guess, more seasoned real estate investors, is something between like a 7 or 10 arm. Main reason being is most active real estate investors have a portfolio, they're growing their portfolio, and then they're recapitalizing every 10 years or so. 30-year fixed is again something we can do, but that's something that's more common when you want to lock in the payment for the house that you live in. Investment product, it opens up a different kind of avenue for capital. We have portfolio refinance solutions that allow you to bundle, currently mainly for long-term rentals, looking to expand that to short-term rentals shortly, but it allows you to bundle multiple assets into one portfolio and do like portfolio-based DSCR calculation with very competitive rates, even non-recourse options in certain scenarios. Non-recourse meaning there's no personal guarantee associated with that. So in terms of term lengths, I definitely see the arms 7 to 10 being more common for the reasons I just mentioned. Most real estate investors recapitalize their portfolio every 10 years or so. So a 30-year fix doesn't always make sense in those scenarios, but again, this is just speaking in generalities. It all depends on your risk tolerance. It all depends on your investment strategy, what your investment goals are. All those things kind of play into what works best for you. So don't let anyone tell you that one is better than the other. It really does depend on, like I said, what your goals are, what your strategy is, what your desired income is.
Awesome.
Outcome, excuse me.
Adam, and what about somebody here would like to know, do you offer any interest-only options? And again, a little bit more about the credit score. So, if you had a score of 500, are you eligible? 600, are you eligible? 700? So just give a little bit more on the parameters, please.
Yeah, we can do interest only. Sure, not a problem. Typically, that's with 5-arm type structure where we can do an interest only. Depends on the asset. For multifamily assets, we can do interest only. So I guess short answer is we can do interest only options. Again, something that's not overly common, but again gets back to what your investment strategy is. And then as far as FICO score, we can get down to like the mid-low 600s, provided there's a rationale as to why the score is at that level. So a common scenario we deal with is clients of ours that are active property flippers or property renovators. So by the nature of doing that business, a lot of people will fund the renovations either on credit cards, so they're carrying high balances, or they're always in the market looking for deals, so they consistently get hit with requests for their hard credit pulls. So it can have the effect of I guess, for lack of a better word, artificially depressing what your credit score is versus a true metric of your credit worthiness. So in those type of scenarios, when we pull credit and we're kind of looking through that credit report, as long as we don't see 30-day lates, especially 30-day lates on mortgage payments, then we can work with with those lower scores. But generally speaking, you're going to start getting the best pricing above 700, and above 740, 760 is really kind of the upper tier in terms of credit score. There isn't any type of pricing breaks or term reductions that occur above that level.
So friends, if you have any more questions that are specific to Adam and Host Financial, please go ahead and ask them now. I'm going to just go on the record here saying that Adam has been a great ally and a great person to do this business with. We've hit a lot of different questions, and he's been really helpful on a personal level to me to get the right information to the right people. And to be perfectly honest, there were certain things that, I didn't feel were absolutely necessary. And Adam went to bat for me and pushed back on underwriting and said, we don't have access to that, or, Richard sold that loan, or his interest in that. And so, as I've taught, and I will continue to teach forever, it's all about relationships. It's all about developing your team. So Adam and his Host Financial are my financing arm and team. And as I grow my business, I'm going to just continue going back to them, both with the line of credit that I have, the cash out refinance, and I'll also share with you my own personal belief on interest rates, which you should just put as a data point. Ultimately, you make your own decision and your own assessment of where we are in the cycle, and match your asset and liabilities for your personal decision. But I'm of the belief that we're in a low interest rate environment for the foreseeable future. And so therefore, I prefer to have shorter and less expensive arms. Whereas, a long time ago, I would have been doing 30-year for my personal home. And as Adam suggested, as I started to move into investment real estate, I started shortening up on the arms. A guy by the name of Alan Greenspan, Federal Reserve Chairman, has been saying for decades now that 30-year mortgages are antiquated and are too expensive. And so I know it feels safe, but part of my mission and my job as the creator of this channel and STR University is to help you overcome those self-limiting beliefs, because believe it or not, going and getting a longer lockup than you require or a more expensive than is necessary is actually helping you continue to play small. So if you're going to expand beyond that, take small steps and expand your comfort zone, and think about doing something that seems risky but might be really smart in the current environment, which is shortening up the duration of the fixed portion of your investment property loan. So if you lean towards 30 years, try 10. If you think about 10, maybe go 7. If you're at the 7 spot, think about 5. And you don't have to do this, but I just want to plant that seed, because these are the kind of things that you start to experience real breakthroughs when you have greater cash flow or you have more flexibility. It allows you to grow more quickly, and that's how you start to grow. There's no guarantees in life. I could be telling you the exact wrong thing. Maybe if you were 7, you should go 10, but I'm just telling you what it is that I'm personally doing on the cash out refinance that Adam and I are working on right now. I'm going 5 years. So I'm going to look here if there's any more questions. Adam, if there's anything that you'd like to add at this point, please go ahead and do so. But I want to just, again, thank you so much for not only your time tonight, but also for being a gold sponsor of Short Term Rental University live in Miami. And I'm going to see if we have any questions. So glad that, Keith is a Nashville guy who's coming back to Miami, so he's going to meet you there. Adam is awesome. Worked with him this summer. Adam, you're doing great. Do you look at the experience of the buyer as a short-term rental manager and the hosting as a factor? What do you think about experience?
That isn't a underwriting like a hard underwriting factor the way income and FICO score and things like that are. It's certainly more of a subjective thing that when we're gathering the pieces of information together during the underwriting process, that obviously underwriters are going to look at that, but it's not a hard and fast underwriting factor. Whereas someone that owns 1 rental is going to get X interest rate, and someone that owns 5 rentals is going to get Y interest rate. Experience and things like that play a bigger role in determining terms for the renovation type financing that we also provide, which is something that you experienced, Richard. that's where experience and things like that come into more play in terms of driving the terms. For the straight, STR or LTR properties, short-term rental, long-term rental properties, it is primarily based on that income of the asset as the primary underwriting factor.
Cool. Adam, there's another question here, which is, can you talk about interest rates and are they dependent on the asset?
Dependent on the asset. No, they're not. So the interest rate for a given financing, whether it's a purchase or refinance, whether it's like a 1 unit or a 4-plex or something like that, is going to be driven by those same factors. LTVs loan to value ratios will tend to adjust based on the assets. So as an example, for a purchase of a condo or a multiplex 2 to 4 unit, we can only get to 75%. For the purchase of a single family home, we can get to 80%. So the asset will dictate more the loan to value rather than the interest rate itself. So the interest rate would tend to be the same, although there are caveats to that where it is sometimes different. So, but it's not severe. You're talking maybe 25 basis points between a loan that would be for a single family asset versus a 2-plex or a 4-plex or something like that. 25 basis points being 0.25%.
So here's another question. How do these rates look relative to traditional financing? So I guess if somebody were to walk into Bank of America, Chase, Citibank, whatever their local commercial lender is, what do your rates look like relative to that?
Well, I guess to benchmark it against consumer rates, which is what you would expect to receive, if you're purchasing your primary residence, those type of loans are obviously backed by the federal government, predominantly sold to Fannie Mae, Fannie Freddie. I'm sure you guys have heard those terms thrown around. Those interest rates are obviously, again, dependent on someone's income and what their FICO score and a number of different factors, but they're in the high 3, low 4% range. And what we're providing is investment business purpose loans. So we're more in the commercial space rather than the consumer space. Actually, all of our financing that we provide is strictly investor only business purpose loans. So no, we can't finance anything where there's an owner occupant component. So you can't live in the property. We can't finance a property you live in, I guess is a good way to put it. But depending on all the factors that we've discussed so far that drive interest rates, the FICO score, the income of the property, the value of the property, location of the property, all those items, generally we are, term length being another one, generally we're in the mid-low 5% range up to the mid-high 6% range, depending on where you fall with all those factors. So, 30-year fix is going to be priced higher than a 5/1 ARM, as an example. Someone with a 800 FICO score is going to get priced lower than someone with a 650 FICO score. But generally speaking, that's kind of where we land based on those factors. So, we're anywhere from a point to a little over a point higher than what you would expect in the consumer market. But we're significantly less than what you'd expect to see from a traditional hard money lender, which, they're shorter term financing, 1, 2, 3 years. They don't, usually they don't fully amortize, and they're, 8 to 12%, depending on who the hard money lender is. So we're kind of, filling that gap. And, we look at ourselves primarily as like a capital advisory firm. We work with our clients and try to give them the best information that we can. And sometimes the best information that I give my client is that we're not the best option. And I did that today. I've recommended it many times before. We're sometimes we're not the best option. Sometimes a better option is, depending on where your income is and what your, personal financial picture is, going the local bank or local credit union route, maybe, a better option, maybe better option for the first 1 or 2. But like I said, a common scenario is that, you'll get tapped out, and then that's kind of the space that we fill. But when we work with our clients, myself, my partners, if we're not the right fit, we'll tell you, and we'll be happy to recommend you to any other institution that might be able to provide financing that's at more competitive rates than we can.
Yeah.
And I offer to all my clients too, when they decide to go another route, I'm like, hey, look, if you get terms from somebody else, feel free to, I'm happy to take a look at it, give you my 2 cents. I'll tell you if it's a good deal. I'll tell you if there's a pitfall. I'll tell you if there's something to watch out for or keep your eye out for. But we're like I said, we're not always the best solution, but we are a solution for a big segment of the market. And we try to, do our best to advise our clients on what we think, is the best option for them.
So I just want to go again for the viewer's perspective. It's perhaps more expensive than you might get elsewhere, but there's a question about whether you would qualify for that, especially as you start to scale. And it's really important to keep track of your goal. What I mean by that is look at the forest through the trees. So if you want to have a whole forest, don't get hung up on any one tree because you're going for something bigger. And I will give you a firsthand example. I did a deal a couple of years ago. It's on the YouTube channel. I purchased a couple of properties at the Snake River Sporting Club in Jackson Hole, Wyoming. And because I needed non-recourse financing for my IRA, so I couldn't personally guarantee it, my rate was higher. My rate was in the mid-6s for that financing. And so I could have gotten hung up and said, well, I could get a point lower and not do the deal and just pass or keep trying to get the lower point. But I really wanted to buy this opportunity. It was pre-construction. And just today, completely unsolicited, I received a bid that's a 200% cash on cash return. So if I put in $300,000, I'm going to make $600,000 of profit from that unsolicited bid. Those aren't the real numbers, but order of magnitude, they're correct. And so for me, I financed at 1 point higher for 24 months, but it led to a 200% cash on cash return. And I would gladly pay that 1% now. I'd even pay 2% or 3%, right? Like, you're worried about pennies in a much bigger picture. Now, it obviously depends on where you are, your outlook, the deal, the real estate, the terms, and so on. But the point in sharing all of this is even though I fought tooth and nail every single day in the hedge fund world over 1/100% versus every other Wharton graduate, Harvard graduate, Stanford graduate. So like Adam will tell you, I beat him up every single day for like basis points. So I'm not the first to just like, yeah, it's totally true. And I know it. It's just like, it's in my DNA. But when I find myself really looking at this and saying, gee, this is a deal that I must do, you can't get stopped out because of something like 1%. If you've got the financing and the deal is great, focus on the big picture and not the minutia, because you'll miss really great trades, really great opportunities, really great purchases because you're just fighting for the lowest interest rate, and that's the wrong place to be spending your energy and time. And so I just want to put that in perspective. 1% is nothing to get the right deal done.
Yeah, and the big thing is just making sure that when you're making that comparison, whether it's 1% or whatever it may be, you got to make sure that your alternative is actually something that's achievable, right? So, you can't be benchmarking investment business purpose loans against the financing you would be getting to go purchase your personal residence, because it's not guaranteed by the federal government. It's not being bought by Fannie or Freddie Mae. It's just they're apples and oranges, really. So I know people tend to, and we get this question all the time, because when we provide term sheets and things like that, they're like, well, I got my refinance on my house for 4.25. It's like, yeah, well, those aren't necessarily the same things. You got to compare it to other like in kind type of financing, investment, business purpose type financing. The consumer lending market is kind of its own thing, mainly driven by the fact that the federal government buys all these buys the loans from the banks that originate them. So that has a big effect in terms of reducing the risk for lending institutions, which is priced in the or you can see it proven out in the interest rate. And that's a good way to look at interest rates too. They're a reflection of risk, right? So low risk investments from a bank's perspective is going to get priced with lower interest rates. If they issue a loan to someone to purchase their home and they know that the federal government is going to buy it 6 months later, the risk to them, default risk or whatever it may be, is extremely low. Private lending and a lot of the institutions that we work with that are funding these investment purpose loans, where there is no, well, the federal government isn't purchasing it. There's a secondary market for all financing, but you have to keep in mind that's how banks and lending institutions price in risk. They price it in the interest rate, so it's reflected in that. So just keep in mind when you're comparing, cost of financing, compare it to like in kind financing, other investment business purpose type financing, not your consumer market.
Cool. So 2 more questions, and then I'm going to thank you and encourage everybody to come to Miami, and everybody who is coming to Miami to bring your deal, to know, what your assets are and your liabilities, prepare your personal financial statement, know which property you're looking at. Adam will be there, and I don't know if you're bringing any team friends, members or not, but Adam will be there for both days, and he will be presenting to all the Miami attendees. If you haven't bought your ticket, we close down on Thursday, so you have 2 days to buy your ticket. There's a few seats left, so buy your ticket now. Come meet with Adam and his team or himself. Start the underwriting process. Get all your questions answered. I'm going to share with you my future-proof formula that shows where I think there's tons of opportunity to generate massive outsized returns with very little risk. And I think Adam and his team will be able to underwrite these opportunities because they cash flow so well. The DSCR is going to get approved. So if you're thinking about growing your business and you don't know where to invest and you don't know how to get the capital financing, that's yet another reason to come to Miami and sit down with Adam and work through your specific questions. So thank you very much for being a gold, sponsor. Really appreciate it. Of
course,
Thanks for your time tonight and also for your future time in Miami. And with that, the 2 other questions here are, let's see. Is there a minimum holding period for a cash out refinancing? And how do you guys determine the value or the comps?
So 2 good questions. Yeah. So I guess what you're referring to on a cash out refinance is kind of more of a seasoning period. And yes, it does play an effect. So it can go one of 2 ways. So generally speaking, if you've owned the property less than 1 year, a couple ways it'll get handled in terms of determining what the loan amount will be. One is the LTV will be based off purchase price plus any renovation costs or things that were put into the property. Or it can be, the LTV can get reduced by potentially 5% on a refinance scenario if you've owned it less than 1 year. The main issue there is that, there has to be significant compelling evidence and rationale as to why the value of a property has increased significantly over a short period of time. If you've owned a property and then you refinance it 3 months later, like how much value creation has really occurred during that time frame? Probably not a lot. So the default position for most lending institutions is to go off of what the purchase price is. Now, if there's been a year of ownership and operation and proven generating income, then yeah, a reappraisal will occur. And that kind of leads into the second question, and something we get asked quite often. The value of the property is going to be determined, based on an appraisal, and that's, common with any type of financing. But they are going to value the property based on other sale comps. They're not going to take a cap rate approach to the value of the property. So if the house is worth $500,000 because every other house in the area is worth $500,000, but you're doing short-term rental that's generating $300,000 a year, that's great. The income's huge. The house is still worth $500,000 because the valuating the asset based on the income that's generating, I think that it's probably something that will occur for short-term rentals and 1 to 4 assets in the future. But currently, that's not how any lending institution views it, because, from another thing to keep in mind too, like any bank always looks at what's the downside scenario, right? So what happens if you default on the financing, they take back the property. Are they in the short-term rental business? No. So they're just going to turn around and sell it as a house. So that's how they value it. The income-based approach, where you look at what the net operating income or the income of the property is, and then dividing that by, what the market capitalization rate is. That's much more a common valuation approach for multifamily, apartment buildings, 5+ assets, things like that. I think eventually that that it will go in that direction, just like there didn't used to be any lending options in the short-term space a couple of years ago. I think that that will change, and there will.
Can I just interrupt 1 second? This is a critical point that I teach on time and time again. And so we may be looking at the lack of financing using the cap rate as a limitation. I want to encourage all viewers, this is really important. That's the opportunity. The fact that we're not at that stage in the financing cycle means that the institutional money isn't there yet. And so we as individual investors can take advantage of this, and we want to sell when that financing is in place. We want to buy when we can't get the financing, and Adam and Host Financial are providing us liquidity to grow. But once we start moving towards that type of measurement, and that's the type of financing that's available, that's telling you that the market is maturing and the opportunity is not as great. The risk is lower, the return is lower. What we're doing now is, in my opinion, low risk yet high return. So I view that as a very positive development, and that's what makes Adam and Host Financial so personally interesting to me and to you and everyone else in Miami. Do you agree with that?
Yeah, I do. And to your point, true institutional money hasn't moved into this space yet. Your old employer, for example, or any of the larger, hedge funds. But what is becoming more common are people that we're working with that are, pursuing a syndicated equity model, where they are raising not insignificant amounts of funds, 5, 10, 15, 20, 50, $100 million, with the intention of, purchasing, expanding a portfolio of STR. So, it's not institutional in the traditional sense, but the bigger money is starting to move into the space because the returns on some of these properties in the right area, which I'm sure you'll get into in the Miami presentation, is just astronomical. Just as a side note, I come from the real estate development background. I used to be a commercial real estate developer for 10 years in San Diego. So, built apartment buildings and office buildings and, big deals. So when I see some of the cash on cash return numbers or the IRR numbers on some of these short-term rental deals, it's crazy to me to see a property that's, as an example, I've seen properties up in the Poconos that are, worth, say, $300,000 to $400,000 that gross $100,000 a year. I mean, you're grossing 1/3 or 1/4 of the value of property annually. Those are crazy numbers. That's not common in, the traditional commercial real estate world. So I think that the bigger money is going to continue to move in, and just like other industries too, consolidation is always very common. We have clients that their investment strategy is to build a portfolio of cash flowing STRs and then sell that to another bigger operator that enters the space and starts gobbling up properties. It's already occurring. So I think that your opinion and analysis is spot on, that the landscape, the short-term rental landscape 2 years from now, 3 years from now is going to be drastically different than what it is right now. Drastically different.
Yeah. And so that's exactly what we'll be teaching in Miami, by the way, right? Is identifying the right locations, the right diversification, creating something of lasting value that you could then sell at a premium. And even if you haven't gotten started or you only own 1 or 2 properties, we're putting in place the logic, the methodology, introducing you to financing partners, and planting the seed on where the opportunity set is, so that hosts can become entrepreneurs, can become really successful. Because in my personal investment opinion, this is the best risk-adjusted return I've ever seen. I mean, it's asset-backed. You've got short-term rental income. You could go to long-term rental income. You could use it yourself. You could vacation there. You could sell it as a comp, like next door or down the street. So the opportunity right now is unbelievable, which is why we're hosting the Miami Live. And we just did Nashville, and we're educating entrepreneurs on how great this asset class is. And you just heard from Adam, who's a prior developer and now has moved into the space, we also talk about ancillary services and the whole ecosystem that will be built around short-term rentals, and how many centimillionaires and billionaires will be built not as hosts, but ancillary service providers in the ecosystem, providing financing, providing cleaning, all sorts of other business models as this disruptive technology really becomes totally mainstream. We're nowhere near there. I personally think we're in the early stages, maybe the second inning or the third inning, and some of these financing challenges that Adam is solving, we should be viewing as an opportunity. So if it costs you 100 basis points or 1% more to get in, that's okay, because the opportunity set is so robust. One question that I have about, and somebody asked here, is about diversification. Will you guys treat multiple properties on the same street, say, independent of one another, or do you guys and your lenders have limits on what you'll loan in, say, the same street, the same zip code?
No, there's no limitations on something like that. It's quite frankly not a specific scenario that we've come across where we're financing one person and then someone else is purchasing an STR across the street. That really hasn't been, an issue that we've run into. We're doing deals right now where clients are purchasing entire apartment buildings, 8 plexes, 14 plexes, and with the intention of operating them all as short-term rentals. So, that type of there isn't that type of diversification issue, at least on our side. So I hope that answers that question. Yeah, it's not an issue. It's not an issue for us or our capital partners. Yeah, and just to dovetail onto your point, at the end of the day, whether it's a short-term rental or long-term rental or whatever you're buying, buying real estate. You're buying an asset, and that's never a bad bet. Even if you
can't tell which screen whether you're speaking or not. So if I'm interrupting you, it's nothing personal. It's just I've got my phone here and I'm listening. I don't know what I'm listening to or what I'm looking at, so I apologize. But again, as a reminder for the followers and the viewers of this, I personally highly recommend diversification. So while you may be able to continue to get financing for, continuing to be the biggest fish in the small pond, I think from a risk management perspective, from creating a portfolio perspective, don't just buy Apple stock, buy Apple and Google and maybe Johnson & Johnson. And you want to diversify. It just makes all the sense in the world, because you just don't want too many eggs in any one basket. So even though Adam and his team can get you the financing, don't necessarily say, well, I can get the financing and deal with familiarity. Again, I want you to think about the bigger picture here. And you think there's less risk in what's familiar, meaning this one unit on X number 1 Main Street's worked really well, so I want to expand. Well, number 2 Main Street is now for sale and I can buy it, and Adam and his team can finance it, so I'm going to get that. But now number 3 Main Street is available. At a certain point, you need to stop and look and say, I'm doing this out of convenience. It's very convenient. My cleaning crews can get there. I can get the financing. I know the street. I know what's going on. And so there's a lot of familiarity, and it seems less risky. But stop and pause and consider the fact that you have all your eggs in one basket, and it may in fact be more risky, not less risky. Doing something across town, across state lines, across the country might actually increase your returns at the portfolio level and decrease your risk. And so I just need you to understand what it is that you're doing, why you're doing it, and recognize that what feels safe and familiar may actually be risky and not worth pursuing. And you need to stretch and get out of that comfort zone in a safe environment, which I can provide you, so that you start to move into the bigger picture. The people that we were speaking about, the institutional money and so on and so forth, that's what they do, right? They may do everything that they need in one town, but then they're diversifying their portfolio. And so if they're really, I'm just making this up, if they're long a lot in St. Louis, they might add, Phoenix, and then they might add Miami, and they might add different geographic diversification, also diversification across asset size. If they're buying 8 plexes, maybe they've got some single family, and then they've got some big apartment buildings. But you need to start to think like the smarter money, and to go where they're going and where they play, you need to start doing some of the same pulls and levers and thinking about it the way that they do, which is exactly what I will be teaching in Miami. And so I just wanted to make sure that you don't get lulled into complacency because you can get financing down the street and that's what you know. I want to encourage you to think more broadly and bigger picture and start to create where real wealth comes in is a diversified portfolio of assets, not only across short-term rentals, but real estate altogether, and real estate plus stocks and maybe some bonds. I'm not very fond of bonds. I never have been, but you start to create a different portfolio of asset classes that are exactly that are complementary, that don't have a lot of correlation, that bring different characteristics to the portfolio. And that's how you stay solvent during downturns. When all correlation goes to one, you have a fighting chance. If all correlations go to one and you only have one asset class and one location, one zip code, it's a flip of a coin. Do you survive or do you not? And I would never want that for anybody who's following this channel and learning and paying attention and growing. So I just want to underscore that. And with this, Adam, I'm going to say thank you so much for your time.
Thank you.
I apologize for the technical difficulties. I think we went through this rather well. We got a bunch of great questions and terrific answers. And I'm going to invite everybody to come join you and I in person in Miami, November 2nd and 3rd. Tickets we're turning them off and or selling out between now and Thursday. So if anybody's watching this, you have less than 48 hours to buy your tickets while they remain. We will sell out. I think there's a couple of seats left. I got some slack here saying there's a few seats left. And to remind people, the last thing I'd want you to do is want to come and miss out on the opportunity to meet Adam and Host Financial and learn where to invest using the future-proof formula and how to create that diversified portfolio. That's all happening November 2nd and 3rd in Miami. And Adam will be there. He'll be presenting, and he'll be there for 2 days answering your questions, your specific stuff. So if you're coming to Miami, do your homework in advance. You got a couple of weeks to get it all together. Get your personal financial statement. Even speak to Adam in advance. He'll tell you what you need, and then bring it down there and spend some time with him. Don't miss the presentation. You'll have to do this after hours or before hours. But the point is, I just want to really thank you and Host Financial for sponsoring, the gold sponsor for Miami Live. Wealth of knowledge, wealth of resources, lots of great information. An honest man who will tell you if you can do better somewhere else. If you do better somewhere else, he'll look at your stuff and just make sure you're on track. And the reason is because he wants to develop a long-term relationship with you and bet on you as an entrepreneur going forward. So our interests are all aligned here, and I appreciate everybody's time and your energy, your attention to the channel, and your desire to grow yourself. So thank you very much. Adam, thank you. Do you want to say goodbye? Anything else I'm missing? How should they get in touch with you?
No, that's great. You guys can visit our website, very easy, www.hostfinancial.com. You can email me directly with any questions that you guys might have, whether it's scenarios or just, you want to bounce some ideas off. My email is very easy. It's adam@hostfinancial.com. I'm happy to, take a look at any deals that you guys have, give you my 2 cents, offer, just have a chat about, general investment strategy or whatever you guys feel like I'm talking about. I'm happy to do that. So yeah, hostfinancial.com or adam@hostfinancial.com. Those are the 2 best ways to get in touch with either myself or one of the members of my team. And yeah, very much looking forward to Miami. I think it's going to be a great event. I'm excited. Yeah.
Cool. All right. Well, you can't see the comments necessarily now, but people love the content, appreciate your time.
Great.
Somebody here said they're not easily wowed, but they are wowed based on our conversation and the opportunity set. So this is what it's all about, right? Like growth and contribution, helping other entrepreneurs achieve self-reliance, achieve their financial freedom. Adam has a great network and relationships and the ability to help fund your dreams. And so I wanted to really put everybody together. And I'm super stoked to see you down in Miami. So thank you. Thank you, Adam. Thank you, followers, everybody. Have a great night.
Appreciate
Be well.
Thank you.
Now we'll see if I can end this thing. That'll probably be easy, like
find out,
audio, video. I don't know.
Yeah.
All right, everyone. Take care. Yeah. Thanks again. Thank you, Adam.
Thank you.